We've also got with us this morning Vikas Khemani, who we're going to get a sense from on really where we're headed in 2020, and he's joining us right here in the studio. Vikas, good morning. Good to have you with us. So where should we start, Vikas? I think it's, end of year, and we're at all these records, but the big question is, 2020, is it going to be a little anticlimactic, a little bit of a, status quo kind of scenario for the year if growth doesn't pick up?
So I think we need to see in the background of what has happened in the last 12 months and how things have changed both globally as well as locally. I think in India particularly, we got into a very chaotic situation after IL&FS crisis, which sort of spiraled into many more, an entire financial system crisis. Liquidities froze. Everything kind of came to a grinding halt and had implication on the economy, which eventually led to the growth of degrowth, very slow growth in the GDP. Now, I think, last 2-3 months, what are the events which have happened? And that will probably, probably give you a clue to what can happen in 2020. If you see Fed, which was in a 5-year sort of tightening cycle, which has kind of come to end. And, Fed has started widening the balance sheet or expanding the balance sheet, almost $60-70 billion every month they are buying. And that's a new kind of, which will open up sort of liquidity in this, economy. And that is very good news, for the emerging market in particular. Dollar strength is over. You already start seeing up, downtick on the, the dollar. So, dollar weakening is a good trend in some sense for EMs. Secondly, if you come back home, RBI is sitting on a significant amount of liquidity. So typically, again, that happens, like it goes other way around when there was a decent amount of liquidity squeeze happened, and that created a problem in the economy, spiraled into multiple effects. Same way, I think it will work other way around. That when there's ample amount of liquidity, it finds its own way through the, various segments of economy. Of course, you need measures. It takes time to get the risk appetite back. Risk appetite goes away fast, but comes back slowly. So, that is the nature of the beast. When the shock is there, everybody freezes, but it takes time to open up, right? So same thing is going to happen, I think. So we are going to see a slow and steady sort of repair on the economy, improvement in the risk appetite. We will see credit offtake picking up, though I think we are still, very, very low and nowhere close to where it should be. So if I were to only say the current scenario is pretty bad, but we see more, since the liquidity is improving, slowly it is getting better. So
it's interesting you mentioned that, because we were actually just having a conversation with some of the big NBFCs yesterday at the India Economic Conclave, and they continue to describe the situation as you've just put it. There is a surplus of liquidity. The RBI governor has said that the NBFCs are yet not lending. He's gently admonished, and they're saying exactly what you are, that listen, the conviction's just not there. But the question is, one is the supply side. The other side is that demand is also not there. And that's another question mark, a big question mark going forward.
I don't think that probably that there's no credit demand. There is a credit demand. Today supply side is a big constraint. I think if you go to SMEs, there are many segments where SMEs want to borrow. But I think if you hear commentary of many banks, they've been saying that we are holding on, we are seeing a lot of risk in this. So the moment you, increase your cutoff for the risk, suddenly, the demand goes away. So it's all about to do which kind of, risk cutoffs, how lenders are seeing as a risk environment. So typically demand is always there at every risk assessment or risk cutoff, right? So I'm not saying that, so typically the demand is lower at a very high, safer kind of profiles. But the economy needs, credit in the segments which are right now kind of broken, kind of not so clear credit worthiness. And that segment, how do you get, credit to? That's very critical. Let's say contractors are not getting credit. Today, a lot of contractors are wanting to do contracts and complete. The real estate sector is not getting easy credit. Even if everything, all ticks are marked, still you are not getting, because the sector comes into, to give a small example, sugar policy is one of the best policy right now, ever India has had. There are lots of sugar companies wanting to borrow capital, and against very good projects, but there is a freeze for the entire industry. Now, how do you define that? So that's the challenge. And how does this reaches to the segment which needs capital? Is the challenge.
So how would you think banks or banks which are well capitalized are placed in this environment?
So see, look, again, as I said that, and banks are right given the experience they have had past. So typically, as I said, that when there is a shock into the system, risk appetite freezes fast. and it takes time to open up.
Yeah.
So I think as the liquidity environment is there, that extreme amount of liquidity will put pressures on the bank. There is, I think, I'm sure there's an environment which is also going to slowly get better. So I think as long as government is also making its own effort to kind of kickstart this whole credit to NBFC or priority funding for real estate, these are some of the measures to kind of support or kickstart the supply of credit to the system. So all those things, when you put together, start moving in the right direction. But I am nowhere making a case that tomorrow it's going to be great in a couple of 1 or 2 quarters time. It takes time, but it is definitely going to be better than what it is today, because today we are in a fairly painful situation.
Yeah. Well, that's heartening to note. I mean, just to put a few of those pieces together, we've had, for example, Chris Wood say that it was shock therapy, maybe, for the economy. Then the finance minister yesterday speaking at the India Economic Conclave saying that, look, we're not in denial. We've been trying to address every sector's concerns. And if we were in denial or we weren't being proactive, we wouldn't be doing that. Yeah. So the question remains, when does that start showing in earnings, showing in the demand outlook? And that no one had an answer for, Vikas. That's still a big question mark.
It is a question mark because, see, again, the thing is that all these answers you will find when things start moving.
Exactly.
Right? And the current hypothesis, at least we have made, is that typically, historically, whenever you've seen abundant liquidity, it has a way of finding out, through the right sector. But it takes time. It is never, a short-term journey.
Yeah.
So, will it be better than what it is today? Answer is yes. How much better it will be? Will it be desired levels of 20% earnings growth? No, those answers I don't think anybody can give you. Because currently we've been wanting to have those, sustainable 18-20% earnings growth for many, many years too, and which has not happened.
Exactly.
So I think to that extent, I think people are frustrated and people have stopped taking a view saying that earnings can probably come back.
But what is the sense on earnings? Do you think earnings X a few sectors will deliver?
So again, by the way, if you look at, it's wrong to say the earnings growth have not come. If you just create different sort of segments of the market, there's a segment of the market which is growing reasonably well.
Right.
I mean, if you see financials within, especially the private sector, banks, which has been growing reasonably well. Non-credit based, financial services has been growing between 18-20%. So that segment has been sort of consumer segment has been delivering well. IT segment has been reasonably, all right. So to that extent, I think, if you see, there are pockets which are delivering well, and the shift of unorganized to organized is anyway underplaying through this. So I think what we all are looking is a broad-based, widened earning growth, which is kind of missing. And we have had multiple shocks from demonetization to GST to IL&FS crisis, and I think it's continuing. Yeah. So we are hoping that all those things are behind, and now this 2020 is the 1 year where we can start seeing beginning of a broad-based earnings growth.
There is still, an apprehension in broadening the investment portfolio. As while you said there has been earnings growth in some pockets, but I think there's still a more preferred bet to kind of go for those safer stocks, a handful of stocks, the ones where valuations are already expensive, but at least they are guaranteed to deliver for the most part. When you say you're also hoping for a broader, move, would you be willing to look further in the markets, like find those quality names now?
Absolutely. See, what the current behavior of only crowding out quality is nothing new. It typically will happen in a risk-averse market, and rightfully, when investors are risk-averse, they will find there's a flight to safety. Yeah. I mean, the reason why dollar was kind of strengthening was there was a flight to safety. So same thing. This happens everywhere, right? I think, and when that flight to safety, changes, when the environment changes towards taking a little bit risk, it is very natural that the shift happens from those flight to safety to slightly more risky names, and that is what I think the whole cycles are all about.
Right.
That you move from complete safety to taking little bit risk, and then you go to extreme risky environment, and that creates a bubble, and then again you see that correcting. So these are the cycles, and I feel and everything has a cycle, and so does the markets. So I think this is a phenomena of that, and that will slowly start getting changing. I believe that. Given if I were to look at two big macro factors, especially around the liquidity, and government is trying to do to sort of kickstart the economy, the probabilities, or I would say, are far higher of that happening. I mean, one can never say for sure that this is going to happen, but I think probability of the earnings recovery, economy coming back, in 2020 are far higher than what they've been to 2019.
There have also been some changes as far as flows into mid-cap and small-cap are concerned. How much of that do you think is factoring in the valuation or this difference in polarization that we were talking about?
So I think, one of the big, dent to the mid-cap rally also, or mid-cap investing happened after the SEBI rule, which I think, mutual funds are getting fairly large amount of money. See, let's not forget that, in India, the investing has shifted big time from direct investing to mutual fund investing.
Sure.
Now, such a large industry, you have restricted them to top 250 stocks. Now, that itself is also creating polarization, right? India cannot be about 250 stocks, right? India has to be wider. Now, even if a fund manager wants to invest into that, he is constrained by the regulation. So, I believe that, one of the probably change which should happen sooner than later is some amount of flexibility on that.
Okay.
And if that happens, I think that will also kind of open up risk appetite, because ultimately the equity capital or risk capital has to go to those segments of, if you say only 250 companies will get risk capital, I mean, that's actually also, depriving wider economy of this, and that rule, according to me, is not really appropriate.
What's the big theme then going forward? Would it be consumption? Would it be looking more at cyclicals? Would it be tech? What would it be?
So for us, it's all about balance. I think definitely, financials ends up being a very large part of our portfolio, which will continue to remain, because I think credit growth will happen. The financialization and penetration of financial products is continuing. So I think that theme continues to remain, and that is not a short-term theme, according to me. That will continue to play over the next 4, 5, 6 years. And which will, which remains largest part of our kind of portfolio. Second one comes to consumption. Again, there are a lot of names which has kind of corrected in this whole demand destruction scenario. And you can look at many of them, and that's again second largest part of our portfolio, we think. And then you will have always some small themes like which are export based, like in chemicals, some IT companies which are kind of sort of leapfrogging into the next league from mid cap. Some of those kind of names can do very, very well. Also provides a bit of a hedge in the portfolio. So I think these kind of things you will do, and those are nothing new, according to me. That will come back. Investment cycle, I think market will take time to recognize, because till the time you see some decisive sort of move in the economy and impact on the that also eventually will do well, but I don't know how long it will take to pan out. Risk rewards are in favor, but it can tire you out before it sort of really picks up. So that we have still not really betted upon big time, but we are waiting and watching. We think that it can be interesting theme.
Well, we're waiting and watching along with you, Vikas. Thank you so much for joining us this morning.
Pleasure.
Always a pleasure
to be with you as always.